I lead the Green Banking Academy, also known as GBAC, for Latin America and the Caribbean. For those who may not be familiar with it yet, the Green Banking Academy was launched by IFC in 2018 and is one of the first global platforms focused on providing advisory services and capacity building programs in sustainable finance, supporting the transformation of the financial sector across multiple regions worldwide today. Today we are very pleased to be launching the Resilient Banking Report, which is a project we have worked jointly with my colleagues leading GBAC in Europe and also in Africa. And this report is grounded in valuable insights from more than 160 financial institutions across the 3 regions, with the objective of understanding where the banking sector stands today in terms of resilience and also in sustainability-related matters. However, before diving into the main findings of the report, it is my pleasure to first invite the managers from the 3 regions involved who did an excellent job supervising the teams that worked closely together to develop this great project. So joining us today for a few brief welcoming remarks, we have Marcela Ponce, who's Upstream Advisory Services Manager for Latin America and the region at IFC. We also have Liliana Pozo, who is Upstream and Advisory Services Manager for the European region. And we also have Paula Maria Leines Felipe, who's the Upstream and Advisory Services Manager for Eastern and Southern Africa. So let's start with Marcela first. Please, Marcela, welcome. And once again, thank you for your support throughout the entire process that led to this new release. And please go ahead, the floor is all yours.
Thank you, Juan Pablo. Good morning and good afternoon to everyone. And thank you so much for being here with us. We are very pleased to share with you some institutional reflections around this report that Juan Pablo is mentioning, and that you will hear more details as we move forward into the next hour and a half. For us, this is an effort that we really praise because it's a collective effort to not only collaborate between the regions to have a better idea of what's happening in terms of resilient banking around the world, to have a better perspective of how we stand from each region in this topic. But it is also very important because it is a way to understand, to identify what are our common challenges here. We listen to the sector. We try to understand how the financial institutions are navigating this rapidly evolving environment. And we are thinking already how we could support you, financial institutions, in that transformational journey towards a more inclusive and sustainable financial system. The core of the report is around clear, high-level snapshots of where we stand today as a financial industry, but also it gives us a shared reference around the current maturity of the sectors, the strengths, the gaps, and more importantly, it's going to inform us about the next phase of resilient banking that we would like to support you with. Sorry, I have a bit of a cold. Across all regions, the banks are being asked to do a number of things, including fiduciary duty, but also they have a number of challenges like digital challenges, technological transformation, integration of climate and social risks into regulations, by the way. All the regulatory frameworks are constantly changing. And in this context, resilience is not only about how to prepare for recovering from disruption, but also how we grow from it, how we use those pressure points to drive innovation, competitiveness, long-term value creation. And therefore, we believe that sustainability needs to be across the institutions, to think about how we offer solutions as financial institutions, how we offer access, use, real impact to our customers, and particularly to small and medium enterprises, which are the drive in our economies and the job creation as well. In Latin America specifically, these challenges are very pronounced. Our banking portfolios are concentrated in economically strategic sectors, but also very sensitive environmentally wise. So agribusiness, tourism, natural resources are all sectors that we need to be very careful because it creates a direct exposure to nature-related risks. And there is a clear need for financial institutions to start working on transparency, traceability, data availability to manage those risks. You are going to hear all the presentations today about each region, but I think that one of the most important messages for you to start this webinar with is we have done a great progress. We've made strong progress on governance and reporting. The institutional structures are in place in general. Sustainability is increasingly embedded into a strategy and the oversight of the institutions, but we need to work on the implementation. I was listening to a podcast recently about the success of the different countries around the world, and the strategy is mainly meant to be like the infrastructure, the structure that we use to grow, to progress, but we need to work on the implementation because a structure with action plans that are not implemented, it's useless. So we need to work on implementation now. And we need to work on innovative products. We need to work on better data systems. We need to work on credible transition pathways. So this is my message to start with. Please bear in mind that this it's not looking for a ranking of the institutions or the regions. We are going to have some comparisons at the end between the different regions and where each region is advancing more than the others. But it's not about ranking. It's about understanding where we are today. It's about understanding the shared challenges that we have. It's about understanding and making the most of the opportunities we have to create sustainable value at scale, not only in one region, but learning from one region to the other, sharing. And I'm sure that we are going to love the perspectives from Europe and Africa as well as we explore these areas. Thank you so much for being here, and back to you, JP or Liliana.
Thank you. Yeah, thank you very much, Marcela. And please, again, Liliana, welcome, and thank you for joining us today. Please go ahead.
Thank you, Juan Pablo. Thank you, Juan Pablo. Good morning, good afternoon, and good evening to everyone. I think we have a really big audience from, I don't know, so 90-some countries. So thank you so much for joining. It just demonstrates the interest in this topic. Building on what we just heard about Latin America and the Caribbean perspective, it's a pleasure to share a few reflections from Europe's experience with resilient banking. I would also really like to acknowledge the strong collaboration across the Green Banking Academy teams in 4 regions. Let's not forget Asia, because Asia has also been part of this endeavor. And focusing on the 3 regions that we're talking about today, we have developed this insightful report on a topic of growing importance for our region and globally, namely resilience and its interaction with the financial sector. In Europe, the report's key findings, together with our own ongoing engagement with financial institutions, point to a context characterized by, not surprisingly, an advanced regulatory frameworks and relatively high ESG maturity, where the focus is increasingly on how institutions navigate complexity and translate ambition into effective action and good business. One of the clear messages from this report is that Europe is entering a phase of consolidation. Most participating banks have moved well beyond foundational awareness and operate within established governance, risk management, and ESG frameworks. Governance and risk management are clear strengths in the European banking sector. ESG considerations are largely embedded into existing risk practices, and compliance levels are high. The next challenge, however, is not about setting new rules, but about harmonizing and simplifying implementation across diverse national frameworks. At the same time, there's a growing opportunity to scale green finance, leverage digital innovation, and accelerate decarbonization and climate adaptation across both mature and emerging European markets. Resilience in Europe today is about closing the gap between advanced risk identification and effective execution. This means moving beyond compliance-driven approaches and using strong governance foundations as a driver of transition, formalizing capabilities, expanding sustainable product offerings, and directing capital towards sectors that generate quality employment and support a low-carbon economy. The European chapter shows how strong standards, transparency, and cross-sector collaboration can position a region as a benchmark. The challenge ahead and the opportunity is to translate this leadership into increasingly tangible, measurable, and growth-enabling outcomes. We look forward to exchanging views with colleagues from other regions and learning how different pathways can converge towards a more resilient global financial system. Thank you. Back to you, Juan Pablo.
Thank you very much, Liliana, for such words. Paula, again, thank you also for joining us today, representing Africa, and for your strong support to this initiative. Please go ahead, the screen is yours.
Okay, greetings everybody, and welcome to this discussion. It's a pleasure to contribute to today's discussion on the findings for the 2025 Resilient Banking Survey. And I really want to thank the GBAC Black team led by Marcela for taking the lead on the important research, and our GBAC Europe colleagues led by Liliana for the ongoing collaboration. But I would particularly like to thank all the African banks who responded to the survey and share their valuable progress. This is an important exercise to capture how far we have come and where we need to focus our efforts going forward. I'd like to particularly appreciate the SADC Banking Association led by Maxine Lava, as well as the other banking associations in the Africa region who stepped up quickly to mobilize their members to respond to the survey. I have the privilege of sharing insights from Africa's perspective. So it's a region demonstrating remarkable innovation and transformation in sustainable finance. We'll be focusing on the key trends across the continent. So in fiscal year 24, in IFC parlance, IFC invested $1.9 billion for climate change mitigation adaptation in Africa, supporting Africa's green transition, particularly in energy, manufacturing, the built environment, and resilient infrastructure. This was made possible by partners in the financial sector and the real sector that are strengthening their capacity and systems for climate and sustainability-themed finance. It is also shaped by the demand for finance to address key regional challenges. So Africa's resilient banking journey is shaped by development priorities that are particular to the region. So we are faced with a rapidly growing population, with an estimated 15 million jobs needed annually to avoid high unemployment rates and economic instability. Droughts cause significant disruption to agriculture, causing food insecurity and economic losses estimated at around 2 to 5% of GDP annually. And Africa requires an estimated $170 billion each year to address shortfalls in energy, water, and transport infrastructure. So in Africa, resilience is deeply practical and operational. As a low emitter of less than 4% of global emissions, Africa is also the most vulnerable to climate change in many respects. This means it is critical for Africa to enhance adaptation initiatives in climate-smart agriculture, infrastructure, and energy, and to build resilience against droughts, floods, and food insecurity. Social priorities, including MSME finance, gender inclusion, and job creation, remain central, reinforcing the need for solutions that deliver both climate and development impact. A growing number of financial institutions are developing products, including green, social, and sustainability bonds and loans, uniquely suited to the continent's development priorities, such as green buildings finance, digital financial services advancing financial inclusion, climate-smart agriculture, and increasingly nature and biodiversity finance, blue economy solutions, and green SME finance. While this new report shows that many African banks are still in the early stages of integration, it also highlights important pockets of progress across the continent. The research confirms that banks are advancing sustainability agendas with growing clarity and commitment, and regulatory frameworks have been a critical driver of this progress. So to date, 16 African countries have published central bank guidance or regulations related to climate risk management and disclosures. Many of these requirements were introduced in just the last 1 to 2 years. However, we are pleased to see that African banks have responded quickly, demonstrating agility in building systems aligned with international best practice. So IFC's advisory work in the region is focused on supporting banks as they operationalize new international standards, including taxonomies, the ICMA principles for green, social, and sustainability-themed issuances, and ISSB-aligned disclosures. Our experience shows that following green bond capacity building engagements, banks are often positioned to pursue issuances within a relatively short time frame. Similarly, once banks have strategies and sound governance structures in place, we see them turn quickly from assessing risk to unlocking opportunities. So in closing, I'd like to say that the continent is entering a phase of deeper implementation, supported by growing institutional capacity and regulatory clarity. We're proud of the banks and partnerships driving this progress in our region, and we invite you to reflect on the potential of African resilient banking as an example of action. We look forward to the discussion ahead, learning from shared experiences across regions as we continue working towards a more resilient, inclusive, and sustainable global financial system. Thank you, and best of luck, Ms.
Thank you very much, Paula, and also thank you, Liliana and Marcela, for such welcoming remarks and for the continued support to your teams throughout the entire process of this project. No? So before we begin today's session, please take into consideration the following important announcements that we are sharing on the screen for you. These sessions offer simultaneous translations, which you can access by clicking on the icon at the bottom right side of your screen. Translations will be available in Spanish and French for you. Also, this webinar is being recorded, and we will be sharing the recording and the materials in the upcoming days. And at the end of this session, we would really appreciate if you could take just a couple of seconds to share your feedback by scanning the QR code that will be shown on the screen for you. Okay, now let's move to the next slide and let's talk a little bit about the context for this webinar and also its main topic. No? As you may know, today it is widely recognized that resilient banking is a crucial condition for financial stability, competitiveness, for quality job creation, and also investment readiness in a context of, as you may know, also constant regulatory and business transformation. With this in mind, through the Green Banking Academy, we decided in late 2024, together with key partners such as the Alliance for Green Commercial Banks in Asia and other crucial allies, to start working on this project to better understand where banks stand today in terms of resilience, what are the main challenges in Africa, Europe, and Latin America, and other regions of the world today, and where the key opportunities lie for the near future for the banking sector. No? So to begin the analysis of the results and insights from the Resilient Banking Report, I will be joined by an excellent group of colleagues today. We will have Sabrina Batilana, who is the lead for Latin America at the Accenture Development Partnerships team. And also I will be joined by my GBAC colleagues leading the work in Europe and Africa, meaning Andriy Saripov and Nkatha Mishira. So I will also take this opportunity to thank the three of them for joining today and also for your great collaboration throughout the entire process as well. So as many of you may know, in mid-2025, meaning last year, we began distributing the Resilient Banking Survey, addressing banks across all three regions, which was going to become the core element of the resilient without whom reaching this report would not have been possible. So again, thank you all for such great support throughout the three regions. And going deeper into the stats, in total, we were able to reach 161 banks representing $2.5 trillion in assets across more than 40 countries in Africa, Europe, and LAC. And I mean LAC, it's Latin American and again, by multiple IFC teams with strong supports across all three regions and also with strong inputs of really useful input from teams in Asia, such as the Green Alliance for Green Conventional Banks, and included nearly 150 questions across more than 50 indicators. As you may notice, the analysis was structured by subregions also, following IFC's own criteria. For example, if you go into Latin America and the Caribbean, results are broken down into the Andean region, subregion, Caribbean, Southern Cone, Brazil, Mexico, and also Central America. This approach allowed us to identify different opportunities to accelerate towards a more resilient, sustainable, and also transformative banking sector. So before moving into the really detailed analysis of results and insights, I am pleased to invite Sabrina from the Accenture Development Partnership teams to walk us through the methodology and bank classification used to analyze the survey results. I mean, here we're going to be doing an overview of how was this survey, the analysis of the survey results done, and how we classify them in order to get to the final conclusions. So Sabrina, again, welcome. Please go ahead. The floor is all yours.
Yeah, thank you. Thank you, JP. Good morning, good afternoon, and evening to everyone. My name is Sabrina Batilana, and I'm part of Accenture Development Partnerships, as it was mentioned. It's Accenture's specialized unit that partners with different multilateral organizations and development finance institutions and governments to deliver impactful development programs worldwide like this one. So today I'm excited to walk you through the methodology that we developed for the Resilient Banking Survey 2025. As it was mentioned, a comprehensive assessment of 161 banks across 41 countries in 3 regions. So let me start by explaining the framework. So when we set out to assess the banking sustainability maturity across these 3 diverse regions, we needed a methodology that could capture actually the full spectrum of sustainable banking practices, while also allowing for meaningful comparisons across the institutions, right? So we built our approach around the 8 sustainability pillars that you can see in the screen right now, each representing a critical dimension of sustainable and resilient banking. So these pillars collectively map the end-to-end integration of sustainability across institutions. So it's spanning across strategy, operations, and governments. As you can see, we have a pillar 1, for example, that answers the question of, does sustainability sit at the core of institutional identity? Or for example, in pillar 3, we have including questions about training programs, performances, incentives, and embedding sustainability into organizational DNA. We also have new, more innovative solutions, and also, for example, business model and suite of solutions like the pillar 4. But also, like the pillar 8, we have communication, alliances, and reporting. That's how it strengthens stakeholder trust and collaboration through different reporting and strategic partnerships. So wanted to give you an overview, but you could read in more detail in the report afterwards. So collectively, these 8 pillars, they provide this holistic view of what it means to be resilient and sustainable banking in 2025. Now, to actually operationalize this framework, we transform the 147 survey questions into 58 measurable indicators that they assess specific capabilities across these pillars, right? They weren't just like yes or no questions, but they were designed to capture the different understandings in the different regions. So also to understand how the banks are doing it. So each indicator is then evaluated and scored according to 3 maturity levels based on performance. So let me go through each of the maturity levels. So as you can see in the screen, the foundational banks are in the early stage. They are the ones that are building awareness and setting the foundation for sustainable banking. They are establishing policies, identifying priorities, and beginning to integrate sustainability considerations into their decision-making. If we go to the next stage that was defined, it's the scaling stage that is divided into 2 sub-levels. So we have developing and rising. So developing banks are embedded are embedding sustainability into the core business operations. They're expanding green products and incentives and beginning to scale their impact. And then moving to the next stage, we have the rising into the scaling level that are banks formalizing their commitment to sustainability through compliance. So they're moving from experimentation to standardization. Finally, in the last and more mature level, we have the leading banks. Those banks are the market leaders. Those institutions have actually moved beyond compliance to competitive differentiation. So they are setting the industry standards, demonstrating that sustainability drives this long-term financial performance. So this maturity framework allows us not just to see where the banks are today, but actually the pathway forward. So asking the question of what does progression look like from foundational to leading stage? If we go to the next slide, we can see that after considering these 3 levels of maturity, one of the key challenges was ensuring that comparability across institutions was also, it wouldn't vary dramatically in the size and operational scale, because we have, for example, regional banks that are, how do you compare like a 50 billion regional bank with a 500 million community bank in a meaningful way? So this is where we came up with a tier classification, and it becomes critical because we classify banks into 3 tiers based on their total assets as reported in public financial statements or different verified sources. So this tiering approach enables us to identify the scalable practices across different market segments and understand what's achievable at each institutional level. So let me go through each of the tier classifications. So for example, tier 1 banks, they include those banks that are ranked in the top 20% of their sub-region based on total assets. So these are typically the largest institutions with significant market share and influence. They often have more advanced ESG capabilities, broader product offerings, and stronger governance structures. Then we have tier 2 banks that are ranked between 20% and 60% in their sub-region. So these banks are not the largest, but they have really relevant market presence. And they play a key role in a national or regional financial system. So many of these tier 2 banks show this moderate maturity in ESG strategy, reporting, and product development, and they are rising. The tier 3 banks are ranked between 60 and 100% in the sub-region, and these are typically the smaller institutions, including local, niche, or specialized banks. So they have limited ESG integration, fewer resources, but that doesn't mean that they lack innovation or impact. In fact, some of the most creative solutions were documented came from these tier 3 banks operating in different markets. So what's fascinating, and this is one of the key insights, is that the size does not determine the maturity. Right? We found high-performance banks across the 3 tiers. So to summarize, our methodology combines these 8 comprehensive pillars, evaluated through 58 measurable indicators that assess across these 3 maturity levels. And they were analyzed according to these 3 institutional tiers to have better comparisons. So this framework allows us to actually generate not just like a snapshot of where sustainable banking stands today, but actually little insights that we will see in this session on how banks can also progress and how the region is developing. So I'll hand it over now to JP, who will walk through some of the key findings. Yeah.
Thank you very much, Sabrina. This is extremely helpful, as I was mentioning before, to understand better how we were able to reach our final conclusions. So building on this methodology, I will now walk you through the general maturity results before going deeper into analysis of each region. So looking at all three regions together, what stands out here is that globally, most banks are no longer at the starting line, but they are not yet fully mature either. So as you may see, roughly 60% of institutions fall under the developing stage, meaning governance structures, policies, and commitments are already in place, but still being formalized. So the good news here, and what I would like to highlight, is that at the same time, almost 1/3 of these banks are already in the rising level, which is very encouraging. These institutions are introducing sustainability into core business decisions, products, and also risk frameworks. So that's something important to remark. However, and unfortunately, there is always a however, very few institutions, I mean, less than 1%, have reached the leading stage, meaning that full integration remains the exception here. So in short, across Latin America, Africa, and Europe, the picture is consistent. I mean, strong foundations exist, but implementation and scaling remain the key challenge here, meaning that this is a story of transition, not of underperformance, as many people may think. No, we now move into the regional deep dives, starting with Latin America and the Caribbean, and this is a region where my team operates on a daily basis, and one that faces significant challenges, but also tremendous opportunities for the banking sector nowadays. So in our region, we were able to reach insights from 70 banks across 15 countries. And what we clearly see is that most Latin American banks sit in the scaling developing stage. And this is also important to remark. I mean, banks have already done a lot of the hard work on governance, and this is something of great value. So here we could say also that awareness is no longer the issue, as banks have already established institutional structures, policies, and governance frameworks, and they have done it really well. Another positive signal when analyzing our current situation is that no sub-region remains at the foundational stage. And this confirms that awareness raising or awareness building efforts have worked well in Latin America. And of course, this is also the reason why sustainable governance and management emerges as the top pillar when analyzing the whole region. So, I mean, to wrap up, the main challenge and opportunity at the same time that we can see in Latin America and the Caribbean has to do with implementation and integration, meaning moving from policy to execution and introducing sustainability into core business decisions. If we move to the next slide, here we are able to see a general overview of each pillar's performance that were explained briefly before by Sabrina, and with a deep dive into the Latin American situation. So let's start talking about strengths. As mentioned before, the strongest area by far is governance, which clearly, with clear accountability and board level engagement in most banks. And closely linked to this is communication, alliances, and reporting. Banks in the region are increasingly comfortable with external disclosure and sustainability reports development that are aligned with international standards nowadays. So the message here is clear. Latin American and the Caribbean banks know how to organize, to govern, and to report on sustainability today. So that's something we should highlight as well. But when analyzing the main gaps here, we can see how these gaps become more visible when we move from governance into business transformation, into business decisions. One of the weakest pillars is sustainable business models and solutions, accordingly. So while some green or sustainable products already exist in our region, they are not yet mainstream, and impact tracking remains quite limited, facing different challenges in Latin America. Also, as you may see, decarbonization efforts are still early, with incomplete methodologies and also timelines, have different challenges also to deep dive and to work a little bit closer on those topics. So if we want to summarize this slide in one sentence, I mean, we could say that Latin American banks lack banks are strong on governance and transparency, but still early when it comes to transforming core business models and decarbonizing portfolios. Sorry. But again, another interesting, if we move to the next slide, has to do with the bank tier performance. That also was explained perfectly well by Sabrina before. So the next natural question that arises here is whether higher maturity is only achieved by the largest bank in the region, or whether it is accessible across different types of institutions nowadays. And what stands out immediately when we see the results is that tier 1 banks clearly lead the way in Latin America. And we can see that over 60% of these banks are already classified as rising, showing the highest level of maturity in the region. But having said that, what I find as a good signal here, and I would like to highlight, is the performance of tier 2 banks. I mean, around 40% of tier 2 banks institutions have reached the rising level, which shows that sustainability maturity is not exclusive to the largest players in our region. And even more limited resources, mid-sized banks are able to make a meaningful progress when governance strategy and also execution are aligned. No? So this is something we can see clear in our region. And on the other end of the spectrum, we have tier 3 banks, which remain mostly at the foundational and developing stages. So only about 10% of them reach the rising level, which largely reflects limitations related to scale, capacity, and resources, rather than lack of awareness. So again, one conclusion that emerges here when we go through the main results could be that it is crucial to continue developing tailored capacity building and advisory solutions rather than a one-size-fits-all approach. And this is something we do and we develop throughout the Green Banking Academy program. We always try to listen to our clients' needs, and after that, try to tailor-make our programs, trying to tackle those needs and also supporting them in their transformational journey towards a more sustainable and resilient financial institution. So let's move to the next slide. So yeah, after looking at the maturity by bank tier, the next question that pops up here is what actually enables banks to move faster along this maturity path, you know? So, and in this regard, one of the most critical enablers we identify is technology, particularly sustainability-related data and analytical tools. So the curious fact when going through the main results here is that while 2/3 of banks have invested in sustainability-related technology, most of them allocate less than 5% of their tech budget to it. So this is something, of course, something that we have to go deeper and try to solve, you know, to work on those solutions. Also, as you may see, only 1 in 5 banks uses advanced analytics for sustainability decision-making. So it is more than clear that the challenge here is not awareness, but capacity building and prioritization, no? Among the C-level, among the governance structure, and among all institutions. We can now say also that technology is the bridge between governance and impact. And without stronger investments in data systems, analytics, and tools, banks will struggle to scale climate risk management, sustainable products, and also strategies. So again, technology is something we should bear all in mind, and is something we should start prioritizing a little bit more. If we go to the final question that arises when we go through our regional results, is what does, the final question is, what does the path forward actually look like for Latin American banks? And these slides summarize it in a very practical way. I mean, the key message here is that Latin American banks are already have the key foundations in place. And this is strong governance, commitments, and alignment with sustainability agendas. And the next frontier is about moving from compliance to action and translating that commitment into real business outcomes. Our analysis points to three concrete specific dimensions where the transformation could take place. And this is, so first is risk management needs to become innovation-led. This means going beyond conventional frameworks and proactively using technology and digital platform to do so. Second, sustainable finance needs to be repositioned not as a niche product, but also as a core capital allocation strategy. And here, I mean, sustainability should be considered as a driver of growth, not just a compliance requirement in the banking sector, generally speaking. And third, and the key aspect here to highlight here, is that there is a very strong opportunity around employment and inclusion, around quality job creation and financial inclusion. Banks can actively design lending products that support labor-intensive and high-growth sectors, such as SMEs and, for instance, sustainable tourism. For example, just to highlight on two specific sectors that should be prioritized in our region. And they can also go, talking to financial institutions here, they can also go a step further, for instance, by embedding job creation metrics into eligibility criteria for social and green financial instruments, for instance. No? So that's a step further. But again, data management and metrics will be key for the near future in our region. So before moving to Andre and to close the message, I mean, the message is optimistic, but very clear. Latin American banks are well positioned to accelerate, but the shift now has to become intentional. No? It has to do with prioritization, and we are here also to support you on that stage. And now, okay, it is also, if we move to our next slide, and this gives me the space. It is my pleasure to invite my colleague Andre, leading GBAC for Europe, to take us deeper into the reality of banking in a region that is both highly advanced and increasingly challenging, such as Europe today. Thank you very much, Andre, for joining, and please go ahead.
Thank you, Juan Pablo, for the presentation and for the leadership on this initiative. As well, delighted to share the parts and was happy to collaborate on collecting the information. Indeed, the topic is pretty important, and by listening their parts related to luck, I just figured out that there is a lot of similarity with the Europe region. So my goal within the next 15 minutes just to guide you through their main insights from the reports and that assessment that we did. So in Europe, what shows in Europe, in region that's has spent years building the solid ESG infrastructure, more surveyed institutions, and we have 53 banks across 13 countries. The vast majority of those countries are developing countries. So this is also important to take into consideration for the other numbers. Those institutions already have what many other regions are still working towards. So clear sustainability strategies, board level oversight on ESG issues, and internal structures to manage climate-related risks. And that's his real trends. That groundwork is done. But the insight from that survey is that Europe often stops at the foundation. Sustainability here is known, structured, talked a lot about, even institutionalized, but at the same time, not yet commercialized. Europe excels at designing the system, but haven't fully switched it on. Most banks sit in their scaling developing stage. Average score is 2.15 from 4, meaning they have moved past awareness but haven't translated it into their true business transformation, true business opportunities. And what does it mean for the banks? The next competitive edge will not come from the having ESG governments. Everyone has it. It will come from that they do with it. Building products, engaging clients, using sustainability to grow. It's not just comply. It's about acting and doing and transforming to the business. Next slide, please. Similar on the pillar performance. On paper, Europe is doing well. 74% of banks have a sustainability frameworks. 90% assign ESG responsibility at management level. 83% have a dedicated sustainability functions. These numbers are excellent. But the paradox is this, that the pillars that represent intent, strategy, governance, risk identification are strong. But the pillars that represent delivery, products, decarbonization, data, job impact are weak. For example, only 32% of banks have an active emissions reduction target. Only 17 measure financial emissions. Only 26 publish a dedicated sustainability reports, and only 9% track employment impact on their portfolio. These aren't failures, the signs of a system still transitioning from compliance mindset to execution mindset. And what does it mean for the banks? This means that European banks already know what they need to do and what to be done. And then the next step is to turn sustainability into the business engine, not just reporting line. This is pretty important. This requires a thinking product design, sector strategies, data investments, and client engagements. Once again, once we're talking about all those topics, it's not about their being aligned with the regulatory, it's how we can create the new opportunities and this really create a lot of opportunities and the value added for your clients. And on the next slide, we will look on their banks tiers performance. It's a little bit different from BLAC. So what we have here, and on the tier 1, the potential leaders, and there is the only bank within their entire survey that's reached the leading position. So those banks have the resources, they have systems, they have international exposures to lead Europe's transitions. But yet many are cautious, waiting for perfect methodologies or regulatory clarity before moving boldly. It will not most probably happen that much. In tier 1 banks could shape the transition finance market, but they need to start acting like market leaders, like market makers, not compliance champions. On this tier 2, with the 40% of tier 2 banks already in rising, this group is the most interesting. They want to do more, but resource constraints and limited tooling often slow progress. The tier 2 banks are Europe's greatest opportunity for acceleration. They are big enough to matter, small enough to move fast, if given the right spots. And then if we will look at their tier 3, and it's only 5% of tier 3 banks reach rising. They are closest to the communities and SMEs, but farthest from the advanced ESG tools and data. And for the tier 3 banks can play a big role in just transition financing, but they need simple fit for purpose solutions rather than complex frameworks. Okay. On their next slide, I wish to also to elaborate a little bit on their on the issues and specifically related to their to the data. Europe cannot transition without data engine. And here's the most important insights emerges. Despite Europe's ambition, most banks still lack the data backbone requiring for transition finance. Only 38% use software tools for ESG or climate data. Only 32% have invested in sustainability-related tech recently. And only 19% purchase external ESG or climate data. This means many European banks are truly trying to drive their transition with the lights off. So what you can do if you don't have the full picture and you don't see and you don't have data. Without standardized ESG data, banks cannot guide clients on transition pathways. They can't design credible green transition products. They can't measure financed emissions. They can't meet CSRDs and ISB expectations. They cannot access on sectoral transition risks and as well benchmarks SME and corporates. It's not there. So what you can do without data, and this is one of the biggest issue that was highlighted by the report. What does it mean for the bank? Data is not longer a reporting issue. It is a strategic capability. Banks that invest earlier will unlock advantages in pricing, client acquisition, and regulatory readiness. Knowing your clients, knowing the challenges, you can better fit to their needs and to deliver what they need. And as well as the results, you have healthier and bigger portfolio. And on my next and the final slides, just to highlight their pathways for sustainable transformation. The survey points to 3 clear opportunities for European banks. First is standardized decarbonization. So move from ambition to action. Science-based, time-bound targets backed by real methodologies. Only a third of banks are doing this today. Third of the banks doing this today. This is the clear gap and definitely the opportunity for vast majority of banks. The second one is turn transition finance into growth markets. Today, sustainable finance is still titled like a reporting category. But Europe's real opportunity is to dominate transition finance, which include industrial decarbonization, buildings, transports, energy efficiency, agriculture, SME transition. And in fact, if you look in each of the sector, you most probably will find a lot of opportunities for that transition finance. And this is where the new products and new margins will emerge. And the third one is basically measure real economy impacts about jobs, about SMEs, about regions. Only 9% track job impact, only 9%. But Europe is heading into an era where social outcomes matter as much as emissions. Banks that can demonstrate job creation, SME development, or regional revitalization will gain regulatory goodwill, investor interest, and stronger client relationships. So you may see that even if we're looking in their ESG, sustainability, or resilience, it's have extreme impact on the topics of their employment, on the development, and inclusive economic growth. Still, I might just finalize my presentation with their visuals, saying that in Europe we have a pretty good skeleton, but at the same time our muscles still need to be trained a lot. And the most important one is to stop looking in their in this topic as the regulatory requirements, as the reporting, but start thinking on this topic as their business opportunity, which, based on our assessments, have a huge opportunities in all the different sectors of economies and as well on the different skills. Thank you so much once again for the GBAC team and LAC by leading this initiative, and as well for giving us opportunity to participate and to represent our region. Thank you. Back to Juan.
Thank you very much, Andriy. Super interesting, and it's always super insightful for us knowing where Europe stands today and what are banks doing in that region as a leading region worldwide now. So before moving to the Africa section, please notice that we will be sharing, as mentioned before, we will be sharing today's recording and also the presentations that we are sharing today with all of you in the upcoming days through the email. And also, it is important to note, I have already posted in the chat box our contact information in case you have any doubt or specific question regarding today's presentation. We can go a little bit further in conversations afterwards. And of course, we will be launching and sharing the final report where we will have the opportunity to go deeper into every of these aspects afterwards. So we will be launching this month the Resilient Banking Report, and we will be, of course, happy to share it with all of you as well. So now, Encatha, I see you there, you're connected. Let me introduce you to Encatha again, our GBAC lead for Africa, and then please go ahead to share your perspective on the current state of resilient banking in your region. Thank you very much, Encatha, again, and please go ahead. The screen is all yours.
Thank you, Juan Pablo, and good morning, good afternoon to all the participants joining us from across the globe. Special welcome to the team from Africa. This is our first time to participate in this survey, and we were really encouraged by the support that we have received from the entire region, with 38 banks participating in this survey from 13 countries, which was very impressive for us. Similar to the other regions, LAC and Europe, we analyzed the survey results across the different pillars, and many of the banks fell within the scaling and developing section, with some banks in the rising section. Again, I'm certain that if we had more banks participating, we would have seen a different spread and maybe a couple of them in the leading section as well. African banks have really worked in the last 1 to 2 years to scale their sustainable finance offering, and a lot of the focus has been on financial inclusion, which is critical for us given the level of our population and bringing in women and as well. But again, there's still a lot of progress that we can make. The main opportunities for Africa have been to go beyond digital financial inclusion and governance, and to scale into actual products, identifying bankable projects, and being able to transition funding to the real population. If we can move to the next slide, please. Looking across the 8 pillars that we surveyed during this analysis, we see that in the first pillar, sustainable vision and strategy, and the second one on governance and management models, this is where Africa came out very, very strongly, with many of the banks reporting that they have in place governance structures, frameworks, vision related to sustainable finance, and they have dedicated committees across board level and in the senior management teams that are overseeing ESG issues. Many of them have in place ESG frameworks and are complying with regulatory requirements around, though many of them are actually still voluntary at this stage. So this kudos to the Africa team on this, especially considering that we are still quite young and nascent in the sustainable finance and banking space. When we move to the third pillar on capacity, incentive, and sustainable culture, this is where I think many of the development finance institutions and even the private sector has come to play a big role, with institutions such as ourselves providing capacity development, creating knowledge and awareness across the region at different levels, and focusing on different themes and topical areas. Some of the areas that are recently receiving a lot of interest are around the regulatory and reporting requirements on ESG and climate risks. And we have also really built capacity in the region to be able to provide support to the financial institutions on this pillar. Training has been happening from board level at the leadership level for many of the financial institutions, going all the way down to the frontline staff who are actually in touch with the business and are the ones who identify sustainable financing opportunities and allow funding to trickle all the way down. When we move to the fourth pillar, this is a bit of a challenging pillar, not just for Africa, but I think across all the regions, where we are now moving from policy stage to actual implementation, developing suites of products and solutions that can actually be deployed into various markets. We have seen a couple of success cases where in some markets and in some sectors, opportunities such as green buildings in South Africa has really picked up, and this has been driven by demand from the clients and by the banks as well, and by developers. So using a three-pronged approach, we have seen products and solutions that have gone to market and been able to scale. But we still need to gain traction across the rest of the region in a number of sectors. One key one that I'd like to mention here is agriculture. And I've seen one of the questions in the chat that is asking how we are providing support to create employment and job opportunities. And agriculture is one of the focuses for Africa, as over 60% of our population is employed in this space. And we are deploying specific tools and facilities around the agri space to enable, and not just agriculture, climate smart agriculture, to enable job employment and to also support food security. Coming to the next stage on ESG and climate risk management and compliance, this has really been driven by the regulators. And one of the challenges that we have here is that the banks need to see the opportunities in sustainable finance and focus on collecting data and reporting, not just as a regulatory requirement, but to see the opportunity that lies therein and be able to take advantage of it. Climate risk monitoring is really critical in Africa, as we are one of the hardest hit continents in terms of risk management, where we have droughts and floods, and building infrastructure that enables us to manage these risks, to measure it, plan for it, and be able to mitigate it is critical. So there is also a big opportunity for Africa, though we have seen a number of, in 16 countries actually, we have seen the regulators put in place guidelines. On the sixth pillar around decarbonization and collecting of data, I think this is one of the areas that we are struggling with. Very few banks have in place systems and platforms that enable them to be able to collect useful information and report on finance emissions and structured reporting. Now, data is a very critical element in sustainable finance, whether it is financed emissions or on the social side, job creation and all the other relevant reporting areas, because data-driven information is what enables us to be able to track performance of institutions and provides opportunities for the financial institutions to go to markets and be able to raise funding to close the gaps that we have already talked about, that financial institutions require in the region to be able to address the sustainable finance gaps. Between 6 and 7, I have touched slightly on data management and tools. And these are the areas where looking at our platform as a global network, we could really learn and borrow from best practice in what is happening in other regions that are more advanced. And be able to implement a number of the tools that they have in place and use this information to really drive decision making on strategy and results and success stories. Communication and reporting is a critical part of being part of the global network around sustainable finance and being able to share knowledge. And a number of African banks are members of the various institutions and organizations and are in partnerships and have been providing communication around their ESG reporting with publicly listed companies, even being able to put on their websites information around their ESG systems and reports annually. So having looked at all those pillars, we are happy that Africa is actually progressing quite well. We have laid the good foundation and a good place for us to start. And I think in the next few years, it is more about taking advantage of the opportunities that we have to be able to take off and grow sustainable finance to be able to meet the demands of the continent. Next slide, please. Again, like the other region, looking at the bank tier performance, many of the banks that responded to the survey were mainly tier 2 banks and that are at the scaling stage. But you'll see that over 60% of the banks in the region demonstrated a high maturity level. Institutions that have provided their sustainability plans and made sustainability a main agenda of their work. The mid-sized banks are also demonstrating good progress around the initial pillars, but again, more focus needs to be put into actual implementation. We also have a number of the smaller banks, tier 3 banks, that are still focusing on putting together their governance structures, raising resources that they need to be able to scale. Next slide, please. I have already touched on this, so I won't spend much more time on it, but being able to measure financed emissions, and even where projects are around adaptation, being able to track the results and report on them is a critical part of sustainable finance. As we always say, what gets measured gets done. And this is one of the areas where we really need to focus on accelerating and growing and getting tools in place for the financial institutions to be able to actually provide data that is relevant to their operations and to be able to support all their operations. I think we can move to the next slide. So looking at across the pillars, the main pathways that we see for African banks over and above the comprehensive visions that they have and the governance structures is the ability to bridge the disclosure gap, again, dependent on data and reporting, and being able to comply with international standards to formalize success for global stakeholders. This provides an opportunity for the financial institutions to be able to go to market, raise capital, and also to stand up and be counted and enhance the reputation of our financial institution. While Africa is not a great emitter, the decarbonization journey needs to be formalized again with formal measurement and reporting of emissions and launching dedicated sustainable finance products. Data management systems and digital infrastructure are key in this day and age, and I have already touched on that in little snippets as we have gone through the presentation. Being able to provide data that can drive everything from strategy to implementation to product development and all the way to raising capital is critical for the financial institutions to be able to play a significant part in sustainable finance and to have strong, resilient banking strategies and frameworks that can help drive Africa into the next challenging period. I think with that overview, I'm happy to hand back over to Juan Pablo for the next phase. Thank you.
Great, many thanks, Katha, for the review on the Africa situation today. And I would also like to take this opportunity again to thank you both for your excellent collaboration and strong commitment in helping us deliver a final report that effectively integrates insights from all three regions and also provides a high valuable snapshot of what banks are doing today, in Europe, in Africa, and also in our region in Latin America. So finally, if we could move to the next slide, Ari. So finally, we still have a few minutes to invite Marcela Ponce again to join us. Marcela, as you may know, is our manager of upstream and advisory services for Latin America and the Caribbean. And we would like her to share some key considerations and emerging opportunities for resilient banking worldwide, around the world, not only for our region. So Marcela, welcome back. Please go ahead. The screen is yours.
Thank you, JP. So thank you so much to everyone. I think that we can agree that there is a lot of progress, but also there is a huge opportunity to keep working on sustainability and sustainable finance and how we bridge the gaps in the market. We have already talked about how this creates more opportunities, and we are talking about job creation, but also how we could try and increase the standards under which we are working, like sustainable governance. So just a couple of points here. These are two key areas where we believe that there's a lot more that we can do. We've been discussing it. One is job creation. Historically, we have been implementing sustainability measures, creating sustainable products or lending to sustainable projects and assets and so on. And we have an opportunity in front of us to start measuring what the impact of that is beyond the environment, beyond the climate. That has been measured through, greenhouse gas emissions and so on. And we can start measuring that on the impact that we are having on employment. What's happening with those investments? Are they creating more jobs once they are more efficient, more productive? So only 22% of the banks in the three regions, Africa, Europe, and LAC, have assessed their operations in light of employment. There is a lot more that we can do here. We can start incorporating new metrics to our systems to start measuring the quality, the formality, the inclusion that this is creating. So that's one. For us, as the World Bank Group, employment has become a key indicator of resilience and sustainability, and we are hoping that through the financial system, we can also start measuring that. The best response in the job tracking area comes from the Africa sample, which is great, and I think that this is a fantastic opportunity to start sharing lessons learned and experiences between regions on how this has been done and how we can start replicating and scaling this up. In terms of sustainable governance, and we know this, there is a need for harmonizing the regulation. This has happened in terms of eligibility when it comes to financing, as we have standards like ICMA, for example, for green bonds, social bonds, sustainable bonds. There is a harmonization there. We are talking about the same things. Same happens with the governance. Although more than half of the banks in the 3 regions have already complied with sustainable governance frameworks, there are some gaps between countries, and maybe a common taxonomy would be good to have a uniform reporting and supervision criteria. So that's another area of opportunity that we can start working between regions. The region with the best response around this particular topic was LAC, which uses quarterly monitoring of the ENS investment impacts backed by certification, market certification. So an area that we can start exploring to work not only between regions from the private sector to understand what would be that common standard, but also from the public sector, from the government side. Can we go to the next slide, please? And overall, the results show that there are strong foundations to sustainable finance, but we are still missing that link, that integration between the different areas of the banking sector with sustainability. What's happening with sustainability in the business strategy? What's happening in the credit risk? What's happening in the lending operations? Are these criteria that the banks are implementing across the institution? There's still some room for improvement there. I'm leaving here the 3 key dimensions that we believe could be worked across the regions. We've talked about measurement of employment and impact. We've talked about regulatory compliance. And just one other point would be data management and analytics opportunity. I think we are in an era that allows us to use more technology and more data than before, and we need to really leverage that to increase or to scale up sustainable finance. So leaving these 3 reflections here, back to you, Juan Pablo. I think it's an opportunity, and I've seen the chat is very active, and I think that we can leverage all the knowledge from the different regions to work on these areas and make the most of what we have available in the market to keep scaling this up, because sustainability is not only environmental, sustainability is also social, and it means resilience in the portfolios, resilience for our clients, and resilience as economies. So back to you, Juan Pablo.
Thank you very much, Marcela. This is extremely insightful and also inspiring for all of us who are passionate about these topics in an increasingly challenging global context, as we all are aware of. So we have a couple of minutes, and this is great news for us. As you may see on your screen right now, we will be sharing the QR code mentioned earlier, so you can provide your feedback and comments. These inputs are extremely valuable for us as it helps us to continuously improve our sessions. I know and I am aware that there are tons of questions in the chat box. We will be addressing them through our contact information that we already shared there. And I also invite you to write us to the Green Banking Academy email in order to continue the conversation and also explore how we can support you going forward on this super challenging atmosphere and financial sector nowadays. So please count with our support. I will finally also will take the opportunity again to thank you, everyone who was involved in this session, but also throughout the entire process of developing and also delivering this resilient banking report that started, as I mentioned before, in late 2024. And this won't be able without their support and also the support of our key partners all around the world. So I hope you found the session today as engaging and also as valuable as we did. And again, we look forward to staying in touch as we continue to advance the resilient transformation of the banking sector worldwide. We will leave the session open with a QR code. Again, this is super useful for us. And once again, thank you very much for joining us today. Have a nice weekend and take care.